It's Sunday, the 23rd of February 2020. Given the price action in gold, I thought it would be a good time to look at the chart again. I know there's a lot of interest in it at the moment, and it's sort of starting to get a bit more generalist interest, I think, as well. And we've obviously had a move to another 7-year high in the last week, and a real sort of decisive breakout in the last couple of days. See some big green bars there, up sort of $60 in a week. And in my last video, I've had the same chart up here for probably the last 6 to 9 months now, and using this previous 2009-10 run as the basis of what the price action is going to be here. And if you remember the last video a couple of weeks ago, I talked about we were sort of in this, look like we're in this mid move sort of consolidation phase. And if you look at that there, it really sort of had the same sort of number of days there, about probably 3 or 4 weeks, and it's broken out nicely this week, as I said. So this range here, that sort of $250 move, if we look at that again, something up toward that $1,700 is the target, I think, in the near future. Obviously starting to get a little bit overbought potentially, but in a real bull market, overbought is not a negative. And I'm not chasing the price here, but I can see that it looks very positive from a chart point of view. And the sort of the consolidation from this consolidation pattern at the bottom between that sort of 1370 and about 1050, that range, if you talk about that as kind of a head and shoulders bottom, it corresponds with that sort of high 1600, 1700 sort of target zone as well, as the first level from this consolidation and breakout that we saw in June last year. So that's obviously been a very positive thing. Just a reminder that this is a free video, and I've got the paid channel as well on Patreon for $6 a month, and I'm putting up a couple of new videos there this evening, and I've got putting up at least one video a week on the stocks on the ASX and elsewhere. So that's, if you're really interested in the mining stocks, have a look at the channel. The link will be in this video. So one thing I thought was interesting, I saw a chart this week on Twitter. I think this was from Zero Hedge, but you can see the US dollar's held strong against all currencies in the last sort of 3 or 4 years, except gold. And gold is really, in the last 18 months, has shown that it's being the superior currency if you treat it like a currency, which I know many investors do. And that I thought that was quite an interesting chart there, given they were in lockstep for so long. And the US dollar move has really been hurting the Australian dollar. And if you remember in the last video, I talked about this 68 range, 66.8 sort of range. If we broke down that below that level, I could see a pretty quick move downward. And that's what we had this week. We actually dipped below 66 on Friday night Australian time. Had a little bit of a bounce because the US dollar's sort of perhaps struggling against some of the other currencies, or had an extremely good run and due a bit of a reversal. There's kind of been this safe haven bid into the US dollar versus other currencies. And in the last video, I spoke that the thing that would break this down is any hint of interest rate falls in Australia, further interest rate falls. And we had the unemployment statistics the other day that were slightly negative, and that was enough to crack the previous lows and this 10-year move downward, 8-year move downward. And now we're in this kind of little bit of an air pocket here, which is why I thought we could move fairly quickly down. And I know, as I said, that US dollar had quite a strong reversal on Friday night. You can see there that it went back up about 0.3% in terms of the Australian dollar. But I think that even if the US dollar starts falling versus gold further and versus other currencies, I think the Australian dollar is going to be the weaker of any of the currencies really at this point. That coronavirus, I think I spoke about this in the last video as well, that as that becomes more of an issue, It didn't look like it was getting better then, and it still doesn't really look like it's getting better now from an economic point of view, and how it's affecting companies and profits and universities and businesses in Australia. I think that's really going to hit the economy, and that offers another excuse for the Reserve Bank to cut interest rates. So I can see them doing that pretty quickly. You can see a couple of companies like BHP warned on coronavirus this week, and if you see a few other big companies start to warn on it, that's kind of the signal to the Reserve Bank. And that's what the ASX 200 is getting, that signal loud and clear. The interest rates are going to come, interest rates are going to come down further, and that's creating this bid up for stocks further. And even though there's companies warning about it, that doesn't matter. The market is really just caring about interest rates now, and it's back up near that those highs again. So that's a bit of a concern. I can see, but that's just dumb money piling into the ASX and pushing up stocks based on falling interest rates. And that's not a thing that should be happening. But it's I think until that narrative sort of changes, you don't want to be short the ASX 200. But there's not much more that the Reserve Bank can cut interest rates. I think they can probably cut them another 0.25%, and then it's the great unknown of unconventional policy and so forth. So that's all being touted at some point in the next year. I can easily see it happening. It doesn't. The language is gradually changing. So obviously that price action in gold and the currency falling is an ideal circumstance for the Australian dollar gold price, which has just gone off like a rocket this week, pretty much up almost $150 in the last fortnight. And I can see it seems just a perfect set of circumstances here that Australian economy weak and the US and the gold price in US dollars strengthening. I've said it before that that's sort of the easiest trade. I think is still that long Australian quality mid-cap gold miners playing this trend, because I can't see what's going to derail this at the moment. It's not the Australian economy just looks in all sorts of trouble at this point. But I've been thinking that for a while, but it seems like now there's probably not a lot that can save it, and you could even see that if you start the R word, recession, starts to come into the media a little bit. That's another excuse for the RBA to cut rates and the government to do more stimulus and all this sort of stuff. None of that's going to be positive for the currency. So that's Australian dollar gold price really just it was almost 2,500 on Friday night Australia. Didn't quite get there. Perhaps due a little bit of a pause now if that the currency weakness sort of stabilizes a little bit at least in the immediate term, sort of the next week or so. The S&P 500, same sort of thing, is not really, all of the stocks are kind of immune from this any real concerns at the moment. It's had a couple of down days. We saw Apple warning about coronavirus and impacts on their supply chains and much to shift units. And the same sort of stuff as in Australia. The big companies start to warn about it, and it's still not really viewed as much of a deal at the moment. It's going to take a while before that starts to filter into data and into earnings of companies. But China's been the engine of global growth for so long now, and some of these scenes out of China with cities that are basically ghost towns, that can't be positive for global companies like in the S&P 500. I saw another chart that was quite interesting also on Twitter. This the top 5 companies now in the US make up a larger proportion of the market than at any time in the last sort of 30 or 40 years. And this is just this is the tech titans: Apple, Amazon, Facebook, Microsoft, and Google in this 19%. And that's really just, I think that's that flood of money that's coming in from indexation and everyone piling into tech and ETFs and this sort of stuff. We're getting that momentum effect now where the same stocks are being owned by everyone, and that's really sort of making them outperform. But obviously that was the peak here in 2000, aligned with the top of the dot-com bubble, and we're kind of seeing I think a similar set of circumstances here. And it's a question of what can derail that. And as I just said, something like the Apple announcement the other day that this coronavirus is really affecting their supply chain, still not really being viewed as much of a negative in the market, but could quite easily be a bit of a hit at some point when it starts to filter through. So I thought that was a little bit of an interesting chart. Um, Gold miners looking interesting as well. The GDX and GDXJ starting to get some love in the last couple of days. You can see there GDX up sort of about 10% this week. Still not above the high that we saw in sort of September last year, and still well below the high in 2016 when it had that tremendous run from that sort of 150% run there. But looking at this chart, sort of zooming out a bit, it kind of looks a bit like that sort of cup and handle pattern. If this last 3 years of consolidation there, and if it gets above that sort of 31.50 to 32 level there, you're looking at a real breakout up to sort of the 40s seems conceivable here. Again, not a lot of resistance in between. And I just feel like that the gold miners have lagged for so long. If we start to see the earnings filtering through into the stocks, there was a few big moves on some of the Canadian companies this week where earnings came in at the market sort of just didn't really expect the earnings to be as good as they were, and has not really factored in this tremendous lift in gold prices and what that's going to do to the profitability of these companies and their ability to pay dividends. I think Barrick and Newmont have increased their dividend significantly. So if we're starting to see these big miners really act like proper businesses where they pay out good dividends and they attract generalist investors, that's going to be the thing that really attracts money into these ETFs, for example. The ETFs, I think it's just, given the way money is now, these passive flows are so important, and the way money's flowed into the tech ETFs, I think if the gold sector goes on a run, you're going to see that passive flow into these gold mining ETFs is going to be tremendous. So that's why I look at the gold mining ETFs. I just see them as very important and a real indicator of that generalist money coming in. So that GDX looks pretty positive, and it looks like it wants to break out there from that, as I said, that sort of kind of a cup and handle in this 3-year long sort of move. The GDXJ actually did break out above its 2019 high this week, and that's had an even better move, probably up at more 10 or 12% this week, and that's still below the 2016 move as well. But again, another sort of cup and handle it looks like in the short term here from this GDXJ consolidation. You can see that cup there and a nice little handle, sort of potentially a move up toward 50, I think, is quite conceivable in the next couple of weeks. As I said, if some of those earnings come through and we start to see that money flood back into the sector. So I think this is the time to own those as juniors again. I've been really sort of focusing a lot on those mid-cap producers, and I think I've been trying to sort of scour the markets for some worthwhile juniors and sort of those real developers. And I think in Australia in particular, there's not a lot of good ones left. In WA, for example, but there's a few companies that will make good money at 24.50 Australian gold prices, and I think that's where I'm trying to start looking now as I expect to see that generalist money come in and those exploration stocks and developers start to get a bid. But obviously, I'm really attracted to quality and not just any company that has gold in the ground, because especially at this micro end, I've talked about this in a number of the videos on the Patreon channel. Just the quality of management and the quality of resources they have in the ground is highly variable. So I'm still trying to look over these companies with trying to have a very discerning eye and be very selective over the ones I pick, because I know that this there's a lot of dodgy companies and a lot of companies that even at high gold prices will struggle to make money. So that's probably all I can talk about just for now. But I think obviously it's a very strong market at the moment, and obviously the gold price 7-year highs, hard to beat that. We're still not seeing much interest in the sector, and that's we're not even close to a full-on bull market in terms of investor interest. maybe if we start to see the stock market roll over and this virus sort of stuff really get moving and see that movement of money from tech, for example, and over allocation in some of these other sectors start to move into gold, that will be, you can see these mining stocks really get a bid. And we're not even there yet, and we're seeing gold up, 25% in about a year, and there's still very little interest here. So that's a positive for me. It still means you can buy these stocks cheaply and wait for that move to come. So as I said, have a look at the Patreon page if you're interested, and I'll continue to put up a few free videos every so often on YouTube. Thanks very much.